The following is a presentation of TFNN. The TFNN Bull Bear Trading Hour. Every trading day, live at 10 a.m. Eastern. Call now, toll free at 877-927-6648 or internationally at 727-873-7618. The TFNN Bull Bear Trading Hour. Now, Tom and Tommy O'Brien.
Welcome, folks. Appreciate you growling and prowling with us out here. We have the Dow Industrials up 41. NASDAQ is flat. S&P's up 7. Gold contract down $2.30, trading at $15.25. We have silver down 10 cents, $17.17 an ounce. Light sweet crude down 70 cents, $54.55 a barrel. Notes and bonds. You get the 10-year up 130.18, 30-year down 1 at 164.28. They both hit all-time highs out here today. You had the 30-year trade at under 2%, folks, and the 10-year at 1.51. King dollar up 134 ticks, trading 97.960. Euro at 111. The yen at 106.23, and the pound out here at 121 to 1 U.S. dollar. Let's go over to our man, Mr. Kevin Hinks at TD Ameritrade Thinkorswim, as we do every Tuesday, Wednesday, and Thursday. And don't forget, folks, if you want to understand the option market, option strategies, futures, outstanding program every trading day right here, 11 to 12 Eastern Standard Time. Kevin and his team, they'll walk you through all these strategies. If you haven't test-driven yet the Thinkorswim platform, real easy to do. As you're at TFNN, just hit that banner, bring it up. They'll allow you to trade with paper money each and every trading day. Kevin Hinks, what's going on?
Good morning, Tom. Good morning, Tommy. Just another day, guys. Here we go. I mean, yesterday was such an interesting day because it was a very headline-driven trade and sell-off, right? I mean, this 10-year, 2s versus 10s, and the inverted yield curve has been a topic for many months.
Oh, yeah.
But the fact that yesterday was the day that it actually got there and crossed over really put some panic into this market, and we can discuss whether it was justified or not, because today we get a bunch of economic data, and the retail sales number this morning, that blows the doors off the expectations for numbers.
That's healthy big time. There's no doubt about that. And
here's what Oliver Rennick and I just spoke about. The control group number, the fourth line of this release, that the control group, they were looking for up 0.3%, came in a full 1% higher.
Right.
Now, that's going to feed into GDP.
Yes.
So with a industrial production number that came out at 8:15 Chicago time, 9:15 Florida time, that was a miss, but the upgrades make it almost a flat number because of the upgrades from a month ago. You may see some upgrades to GDP midday because of that control group on retail sales. So I expect midday for some slight to pretty strong upgrades in third quarter GDP because of this number.
Yes. No, I can see that. You know, I just want to switch gears on you for a second.
Sure.
We've been talking about the VIX, right?
Yeah.
And, there's a great story out here, man. And we've talked about it before, like the trader we call him 50 Cent. You never know who this is, folks, okay? This was about a year and a half ago. But there's been a couple huge trades in the volatility index in the option market. And one of these stories, Kevin, it goes back about 6 weeks ago. Someone put on a trade. They figure they're up about 170 million right now. And what happens, folks, you don't know whether they're really up or they're hedging a portfolio, right? That being said, out in Bloomberg this morning, Kevin, so check this out. This is pretty wild. That the Bloomberg's talking about that there's still, right now, they think that the banks are on the hook. Listen to this, man. This isn't, because, okay, so we get the VIX at 21.97.
Right.
That when this trader, you don't know who it is. When the trader come in the market, folks, and put this on, the banks are on the other side of this, and they're shot a series of VIX calls from 20 to 24, and they're trying to do damage control right now. And it's so intriguing to me. I'm saying to myself, we're wondering why this VIX is like staying at a lower level. I'm saying to myself, oh man, there must be a battle inside this. Could you imagine that if you're the bank that's sold, you're on the wrong side of this deal? It's like, okay, man, because you're hovering right at that 22 levels. You know what I mean?
Right. Right.
Pretty intense.
Hey, listen, here's two things on that. Number one, when someone makes a big bet like that on volatility, they're probably long the market as well.
Yeah,
that's probably not what you mentioned. That's probably not a standalone trade.
Right.
They're hedging something.
Right. Exactly.
So
right.
that's the first thing. Number two, the people on the other side have probably hedged that trade as well.
Right.
Right. Whoever took the exposure for the VIX up here has probably did something to hedge it as well. So there's a lot of ways to mitigate risk in a portfolio via direction, via risk in volatility like you saw here. So, hey, listen, people make bets all the time, and think about it. What it probably is, Tom, is someone that is long the S&P 500.
Yep.
Right? In baskets or via options or whatever. But you're long the S&P 500 and you hedge because knowing that if the S&P 500 goes down, VIX will go up.
Sure.
So long S&P 500, long VIX may be a position that they have on.
No, listen, I brought it up because I knew you'd have some answers here.
No, it's fascinating.
It is fascinating, man. Do you know what I mean? Because it's like, you can make these bets, folks, many times, and it only has to come into fruition a few times when you're talking about, a VIX that just went from 15 to 22.
Right. Which, if you think about it, that's about a 45 to 50% increase in the VIX.
Yes.
Right?
Yeah.
Not a bad number, not a bad return if you played it correctly on the strike prices you used and things like that. So, yeah.
Now,
hey, I like it.
Yeah. Now, Walmart, man, you talk about, they've always been a monster, but that you talk about sales growth, man, that's pretty intense. They're talking about Sam's Club up 3% comp sales.
Right.
The huge box stores, folks, are 2.5 to 3. That's what they're looking for. They're looking at the upper end of growth now.
Their same-store sales for this quarter, 2.8%.
Yeah.
U.S. comps up 7%. Revenue, $130.4 billion. And e-commerce for this quarter up 37% at Walmart, looking for 35% for the full year e-commerce. So, here's the thing that I want to say about this. If you looked at after the retail sales came out, we actually had another number for non-store retailers.
Okay.
I don't know if you saw this. And non-store retailers up 2.8% this month. That is online, buying.
Okay.
And year over year up 16%. So the U.S. consumer is alive and well. You're just seeing a pretty catastrophic transition from box retailers to a combination of, big box, low margin retailers and online sales. So this economy is strong, but shifting some places. And as you guys know, when economy shifts like this or transitions, there's going to be some carnage for the people on the wrong side.
And you know what's so cool, folks? When it shifts to consumer spending, man, that we've seen it. You get consumer spending going, man, you can go for years on consumer spending, man. I mean, it's always more powerful than people realize.
When in doubt, Tom, bet on the U.S. consumer.
No doubt, man. Well, listen, it's always a pleasure, Kevin. We look forward to the show in 45 minutes. You have a great weekend, safe weekend. Look forward to speaking next Tuesday.
Tom, thank you so much for having me on.
Thank you. Stay right there, folks. Come right back.
If you're not currently using the TAS Profile Scanner when looking at setting up your trading opportunities, then your arsenal is short a mighty weapon. The TAS Profile Scanner is a standalone piece of software that instantly filters over 2,500 global financial markets such as stocks, ETFs, commodity futures, and Forex. Headed by Steve Dahl, TAS understands that in today's technological world, the use of top-flight software applications and technical analysis expertise is essential to successful trading in today's market. You also gain access to the webinar that Steve Dahl and Tom O'Brien just hosted, The Best Way to Use the TAS Profile Scanner to Profit. This webinar archive is available for all subscribers immediately upon signing up. All new subscriptions also come with a 30-day money-back guarantee, so you have nothing to risk. Start your subscription by visiting the front page of TFNN.com today, and you'll find the TAS Profile Scanner under the Services tab. Sign up today. Are you in the market for buying or selling real estate in the Bay Area, including the surrounding St. Petersburg, Tampa, and Clearwater markets? Tiger Real Estate LLC is a firm that has extensive experience in the Tampa Bay area. Whether you're looking to sell your current property for maximum value, or you're in the market for a second home or investment property, Tiger Realty has the experience across all areas of real estate in the Tampa Bay area to help buyers and sellers make the most informed decisions across all price levels. From the price you should be paying per square foot in certain up-and-coming areas to the type of cash flow investment properties are capable of creating, Tiger Real Estate can help you make the best decision when it comes to all areas of the market. Before you make one of the biggest decisions of your financial future, call Tiger Real Estate LLC today at 727-329-8322 or email us at tiger@tfnn.com. That's 727-329-8322. Call us today.
Many of our new listeners have heard about the Tiger's Den. The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of the TFNN shows, plus see all of the charts as they happen live and have access to archives of all of those charts. You can test drive the Tiger's Den absolutely free for 30 days and greatly enrich your knowledge of these markets and how to make your money work for you. Details on the Tiger's Den are on the front page of TFNN.com.
TFNN has launched our brand new website. You can still visit us at the same TFNN.com URL, but when you do, you'll see a new and improved homepage with a much simpler navigation, whether you're watching Tiger TV live in high definition or just accessing your newsletter subscriptions. We even have new pricing in 6 months and yearly options. Check out the new TFNN.com now and experience all the upgrades. TFNN.com, educating investors.
Call now, toll free at 1-877-927-6648. Internationally at 727-873-7618.
Welcome back, folks. Dow up 24, Nasdaq up 5, S&P's up 8.5. Let's go take a look at some of the higher volume. Well, here, let's go to GE first. Okay, so GE, folks, this is going to be pretty wild watching this. We've been watching this play out for years, and you know, my take on this is the whole time is GE's been cooking their books for a long period of time, and now what you have out here this morning, this is Harry Mitropoulos. This is pretty cool because this report, this is the guy that first came out with Madoff, that bottom line was telling the SEC as well as anyone who had listened that Madoff had been cooking his book for years. No one paid attention. Bottom line, we know how that shook out. And this morning, in this report, he's talking about GE cooking their books, and I suspect, you know, as this lays out, it's amazing to me that actually the GE has got along this far without serious implications about how much they've actually already written off. They've already written off billions and billions of dollars, you know, and what happens with a write-off, by the way, folks, is that when something is material to a company, the bottom line is that they're supposed to write it off. You don't supposed to leave it on the books, and you're leaving equity on the books. So what he talks about today is that he thinks the insurance unit, there's no doubt, the insurance unit, okay, so watch this. This is how this insurance unit goes. They spun off Glenworth. When they did that, they spun it off, but as they spun it off, they have all the legacy issues. So any losses that come forward, that's their losses. And the Glenworth deal, folks, has to do with long-term insurance. And what ended up happening is that if you were lucky enough to buy long-term insurance years ago, right, it was probably one of the best investments that most people ever made. You know, people at the time were saying, no, that's not good. It was one of the best investments. Why? Because what has happened is that the long-term, the insurance in general, no, hospital care in general, has gone up dramatically. The insurance company sold it way too cheap for what they had to go on the other side. So there's billions and billions of dollars that they are now putting out. So he's saying that he thinks that they have to increase their reserves by $18.5 billion in cash there. No, just right away, okay? he is talking about they improperly accounted for their interest in Baker Hughes, an oil and gas service company. Bottom line, when push comes to shove, he's talking about, I believe he's talking about $40 billion. So here, let's look at this for a second. So you got a GE Capital right now, or it's not GE Capital. So you get a market cap of $72 billion. Yeah, you get a market cap of $72 billion. He's saying that $40 billion should be written off. GE's trading $835, and this is going to come out, man. This is going to come out in the cleanest, because what's going to happen? It'll take years, but bottom line is that we're going to see that GE's been cooking its books for years. I mean, well, you can just look at the chart and say, okay, listen, you know, they claim that, you know, things are cool. Well, guess what? GE in 2016 was 31 bucks. You're talking about $8.36, and this does, you know, look to me like it's going to go right back down to $6.91. And what it's never done, and I suspect we're going to get there, is $5.50. $5.50 is the low of 2008. And what we did not do, this did a sideways movement for 7 months now. Your leg down went like this. Your leg down went $31 in 2016. You got down in December of this year to $6.40, and then sideways. This is going to be, this GE deal is going to be a lesson in a lot of different things. You know, you had one of the largest companies in the world that everyone trusted, and then all of a sudden, guess what? You know, and it will actually show how many years it takes to basically fall apart. And I suspect GE is, that's it. It's going to be here. Some of the other high volume equities, this is what we have. You have GE is the #1 volume equity out here today. You got Bank of America up 11 cents. Tapestry, that's down 473. Now that's the high end. They changed that from, I forgot whether it's not Kate Spade, it was, that's a high end products anyway. So bottom line is that, let's see what this is. So this is, well, design market close. Yeah, pocketbooks, travel accessories, fragrances. They own Kate Spade. They own, who else? Stuart Weissman. Bottom line is that this company is getting toasted and roasted too. This has been a one-way trip down. This company was trading at 76 bucks. You're at $20. I'll bring this back further and see where this boy baby wants to go. Okay, so this is going after the look at this, going after the swing low of 2009. You're at 20 bucks right now. $18 is game, and as is $11. So you're talking about some numbers here. You get look at Transocean, man. Transocean's trading 382. That's a slow death. Transocean rig is a slow death. This is sad. Look at this, man. This is crazy. This is we'll be reading about this in another couple weeks. This is going to go on BK. As soon as it got underneath this $6.19, you're 382 right now. You know, we were there 8 months ago. There's just nothing left there. It's zero is what's left there, and it doesn't look like the oil market's going to save them, because if we go over to the oil market right now and you look at the oil market, what you're going to see is that you're trading 54.84. This is building cause for lower price. You know, your dead cat bounce came in, couldn't get anywhere. You got up to $57. A couple hours, gave it up again, and you continue to stay at the bottom of the consolidation that's taken place here. So that's a consolidation going sideways, building cause. If we look at the marketplace, folks, my take on this marketplace goes like this, that you came down fast and furious. Well, first you had the pop on the tariff that they absolutely couldn't hold at all. Sold off overnight. Monster volume yesterday. You get a little bounce out here. I don't see a big bounce coming. I would be selling every bounce you hit, because the heads up here is that you're going to the June swing low on a short-term basis. You're going to the December swing low on a longer-term basis. And if you're looking for another $500 to a $700 pop on the upside, I don't see it coming. And the reason I don't see it coming is the way that we already got a couple, number one, but it has to do with the way that we sold off overnight when we came into yesterday, because there wasn't really heavy news overnight when, in fact, that S&P was sliding all night long. That is telling me that you got money managers right across the world. They're feeding into that market before the markets actually open up. That is always a danger point in a huge way, because what ends up happening is, just as I'm talking to Kevin, you know, if you're set up right, the bottom line is that you don't have to wait for the market to open to sell off. You can be selling off all those S&Ps all night long, right? And then you sell off the equities in the morning, and what's going on there is you're not losing on the equities because you're making on the S&P. But what you're doing is that you're selling off in an orderly manner overnight. And when you're selling your equities during the daytime, that is just closing the position that you did overnight. Stay right there, folks. Come right back.
Hi folks, Tom O'Brien here. If you'd like to get my daily newsletter, Market Insights, then now is a great time to sign up for a 30-day free trial. Every morning by 9:30, I send out my morning letter to subscribers with market commentary on a variety of markets, currencies, and commodities to keep investors up to date on the day's trading action. Included in Market Insights are specific buy and sell recommendations for stocks, ETFs, and even options, with stops and price targets included for every trade in my newsletter. If you'd like to try my newsletter risk-free for 30 days, then head over to the front page of TFNN and you'll find Market Insights under Trading Newsletters. I use my years of trading experience to bisect and dissect the market every morning and give my subscribers the most important information they need to know for the day ahead. I even issue afternoon updates for my subscribers whenever warranted with important market action. I'm always scouring the market for the next great trading opportunity. Sign up for your 30-day free trial to my daily newsletter, Market Insights, today by visiting the front page of TFNN.com. Wow! Go get 'em, folks.
The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN and you'll find The Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now. TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABCs, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Welcome back, folks. Dow is down 23, Nasdaq's up 4, S&Ps are up 2, and you can see just the market just has a hard time holding price whatsoever, folks. We go take a look at the one of the tigers just gave me a heads up even on Halliburton. If you want to see this oil sector, man, is pretty intense. Halliburton in 5 months is down from $32 to $17.60, and if you bring this back, you're going to see that bottom line is how Halliburton is going after its 2008 swing low. You're talking about $12.80. You've broken everything. In fact, well, look at this. So watch this. We did this before, man. Okay, so this is Halliburton's in a monster ABC down. Let me see if it's out of business down. 54, 30 bucks. Okay, so check this out. Bring this closer so you can see how this works. Right there. Okay, so this is on a monthly ABC structure down, a confirmed ABC structure down here. Your A point on this is $57.86. That's January of 2018. So let's just ballpark it at 57. Is it 57 or? Yeah, 57. And you get 24 at the bottom. So we get, oh my God, $33. And guess what? At $33, the C point is $32.71. This is going to be wild watching this, because that's saying that this equity can go to zero. Let me pull this back. And the all-time low on this is $4.40, and that's in 2002. Yeah, so you're talking some real numbers there. You know what's intriguing is that I heard, this is kind of cool how this does work in the shale business. So what happens is that in the shale business, folks, okay, when they drill a well, this is how quick it is. You drill a well in the shale business, they have oil out of that well 14 days later. Just like that, okay? That is saying that there's so many of these, okay? It's surprising that the oil is actually, to me, it's surprising that oil is actually held up this long. Because guess what? When you can bang that out on a continual basis, every little pop that we get that comes into $55, I can picture, they just open them up again. Okay, we get this one ready to go. Bang, we open them up 14 days later, or you get oil coming out, you sell it as quick as you can. You talk about a supply line. That supply line's got to be a monster versus the demand line on the other side. And you can see why the Riggs of the world, the McDermotts of the world, the Weatherfords of the world. Weatherford's already went out of business. McDermott filed, and Riggs probably going to be next, because all of those folks, they depend on deep water. And guess what? You don't need deep water drilling when we have so much oil, basically shale level. That's what it comes down to. The financial market. Let's go take financial sector. Let's go take a look at the XLF. Now the XLF also, folks, is giving us a heads up that not only lower prices are coming at us, but the December is on the agenda. And the reason I'm saying that is that the swing low in the XLF for June is $25.92. We hit $25.96 this week, and we're going to hit this with tremendously higher volume. So picture, 225 million is the statistic. We're already at 181. So let me see, 225. What have we been doing every day? 225. Yeah, we did 92 yesterday. You did 72 the day before. We're at 13 right now. That's doable. You know, if that's what we get, that is saying that, guess what? Your probability gets higher that the S&P is going there. You take a look at the Berkshire Hathaway. Berkshire is already into the bars of December. It's just because Berkshire's in a huge consolidation. The bottom of that consolidation is that 184 number. What we did do yesterday and this morning is you got a lot of these 13F filings out. So what is cool with the 13F filings, of course, is that that'll tell us where the funds are coming in to equities, where they've been going out of equities. Okay, so let's go over just first the GLD and see if we have any new players inside the gold market, inside the ETF structure of the gold market. When we pull this up, no reported holders, GLD, no, that's not right, okay. GLD, there we go. Okay, so the largest buys, we're going to go, okay, oh, this is interesting. Look at this. So that's a new player. We get Goldman Sachs as a new player. No wonder. Yeah, that's interesting because he had Jeff Curry on this one. Goldman put a new price of gold, folks, up to $1,600, and they, as of that's a new buy for them. They They had 500,000 shares prior to the last filing. They bought another 2 million. Bank of Nova Scotia, they came in with another million. You had Mitsubishi Financial and Japan come in with another 1 million. SG American, 500,000. You get a lot at that level. Now the cells, so that's the cells. You had Morgan Stanley move out a huge position. They moved out 3 million. They had 8 million. They moved out 3. JP Morgan moved out a third, no, 2/3 of their position. You had Wolverine Trading move out. No, that was March. Alphonse Investment moved out their full position, 1.1 million. And you know, there's when I actually take a look at this on both sides of it, it almost looks like, now this is going to be impressive because it almost looks like you had more positions getting moved out than actually buying. I'd have to add these up, but that's what it looks like. Now that's going to be impressive. Well, actually, no, you had someone, this Krung Thai Asset Management came in big. They came in with 12.6 million shares. So that certainly is a big number. Oh, I see. This is a, where this is located. Oh, look at this. Oh, this is interesting. 1 second. Hold on. I think these are China companies coming in. Okay, so these are China companies coming in the ETF market. Let me see this. And they came in big. I got to find out where this is pretty cool, man. Okay, this is going to end up being news. This is definitely going to end up being news because this hasn't hit yet. And it actually should have, because I didn't see this. They actually came in last quarter. This filing is from March 29th. And they are the largest, yeah, it looks like they're the largest owner right now. Here, let me see. Yeah, they're the largest owner. Let me do it a different way, PHDC. Almost looks like they're the largest owner in the GLD right now. Yeah, they are. Yeah, 4.49%. So we'll find out where that is. I'll find out where that is right at the break. There's a city there, but it doesn't say what country that city is from. 877-927-6648 Dow. Dow is up 36, Nasdaq's up 12, S&P's up 10. Come right back.
If you're in the CD market and looking for a secure investment, the Tiger First Mortgage Program may work for you. The security for these first mortgages are building lots in a tax opportunity zone in St. Petersburg, Florida. The Tax Act of 2018 set up tax-free zones across the country where you can build and hold for 10 years and pay no tax on the profits, which makes these lots valuable. The investment is anywhere from $30,000 to $75,000. The interest paid is 7% yearly, paid on a monthly basis. According to Bankrate.com, the best rate for a 4-year CD in the country as of February 20th is 3.1%. A $50,000 investment at a normal 4-year CD rate of 3.1% would give you income of $1,550 per year or $6,200 over the 4-year period. That same $50,000 investment in the Tiger First Mortgage Program would give you $3,500 per year or $14,000 over the 4 years. Which would you prefer, $6,200 or $14,000 of interest on your investment? If you would like more information about the Tiger First Mortgage Program, you can call me at 877-518-9190. That's 877-518-9190.
If you haven't checked out the newsletters page of TFNN.com, what are you waiting for? All of the TFNN newsletters are informative, up-to-date, affordable, and a must-have for every trader looking to gain a competitive informational edge in today's markets. TFNN newsletters cover every aspect of the markets to offer you the very latest in market news. Plus, new subscribers get to test drive our newsletters risk-free for 30 days. From all aspects of the markets, including stocks, bonds, metals, commodities, and tech, there's a newsletter to fit your needs exclusively from TFNN. Stay informed each day you trade and get that competitive edge that will help you stay ahead of the game. Visit our newsletters page by going to TFNN.com and click the newsletters button near the top of the page. TFNN.com. educating investors.
Biotech is booming, but for how long? Whether you think the biotech bull has room to run or has run its course, trade LABU or LABD. Directions Daily S&P Biotech 3 times bull and bear ETFs. Visit directioninvestments.com/biotech today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction shares. To obtain a prospectus or summary prospectus, please contact Direction shares at 866-476-7523. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors. Distributor Foreside Fund Services, LLC.
Don't forget, you can listen to TFNN live on your mobile device 24 hours per day. Go to TFNN.com, then hit Watch Tiger TV. That's TFNN.com, then hit Watch Tiger TV for the latest market information.
Welcome back, folks. Dow is up 19, Nasdaq's up 3, S&P's up 8, and I just checked that fund, folks. So that fund that is the largest owner right now of the GLD is in Bangkok. Yeah, that's and here's a picture. You gotta love the internet, right? There's their offices right there. One Empire Place, and that's in the second word is it's. Bottom line is that it's downtown Bangkok. So we'll see where that whole thing shakes out. But the gold market certainly just continues to refuse to back off. And right now you're up $2.60, and you get huge volume here. This is going to be really intriguing watching this shake out because we're already at 321,000 contracts, and you know they're holding price here. But guess what? When you keep banging into highs and you get an expansion of volume banging into highs, 321,000 contracts, folks, is a huge amount of contracts this early in the morning right now. So I expect what we're going to see is this is going to make that run for the all-time, well, not the all-time, the highs of last week, which is, that's last week we got the 1546. You gave it up on price and you closed at 1514, but yet we had gone all the way lower to 1488. That's about as deviant as you can get, because you got to remember something. The gold contract is still in an ABC structure on the way up. It's a confirmed ABC structure. You know, you're talking about a price point of the 1575. The amazing part that it's holding steady is that the King Dollar is still at highs. You know, so it's like, okay, you know, there's a lot of parts out here that you normally would not have gold at highs as King Dollars at highs. That's just how it flies. But guess what? It is what it is. If we go over to the yen and we take a look at the yen, what you are going to see with the yen is that the yen, you know, bottom line, got a pop on Tuesday night. You know, the yen went from a price point of 105 to 106. Out here today, it's not holding price. You know, we got up to 105.70. I mean, 106.78. Right now, you're trading out at the 106.23, and let's just go to the Nikkei for a second, because the Nikkei goes out of its mind when the yen keeps getting stronger. Yeah, and the Nikkei didn't hold price either. So check this out. This is a heads up on itself. So the Nikkei, you know, you're down from 27,000. You're 20,000. You banged into the high volume low last night, and you had already broke the swing point. So. Yeah. See, so the Nikkei has already got to its June low. The June low in the Nikkei was 20,290. We got to 20,110. So that already broke that. Now what it's doing, folks, is working on the December swing low. This is pretty cool, because this is also telling us that your probability keeps going higher. That's where this S&P is going. Because when we take a look at major indices across the world, when they get there, you know, it's only a matter of who gets there first, what sector gets there first, and how does it get there. And in the case of the Nikkei, you got to the June swing low, has volume at the June swing low. Now you're building cause. That brings the probability much higher that we're going to go after the December swing low. Let's go to the DAX in Germany. DAX in Germany today hit 11,266. Now you're 175 points off of that, but you're still down 80. And yeah, this is a different setup, but the bottom line is that you're already into the December bar. The top of the December bar for the DAX is 11,566. And that's saying that's going to also get to the lower end of that, which is brings the probability much higher. We go to the FTSE. Look at this mess. Wow. Yeah, the FTSE. So this has been a one-way route on the way down. You went from 77 to, so the FTSE's down 10% in a month. You're already into the bar also. Yeah, this is going down to December. The top of the bar is 71, the bottom is 65, and you're at 7,000 right now. So, well, let's go look at Deutsche Bank, because this is a trip. I heard this morning. Let's say Deutsche Bank, that broke the $6 level, or $7 level, I guess. So Deutsche Bank, look at this thing, man. Yeah, your last swing low out here was 685. You're at 656. 673, 660. Oh, this is going to be a big day for Deutsche Bank out here, folks, because this is what's going on, is that you just broke everything. Yeah. So if this kind of get up above $6.60 today, you know, this has been a slow death keel for Deutsche Bank, no doubt. But I get a feeling that this would be the last swoon, meaning that the government will have to come in. Yeah, you're 20 cents below any place that we've actually traded here. So, you know, you get into those levels, and that is big problems. And that's no doubt. You know, you talk about a monster bank. Well, it used to be a monster bank. Bottom line now, it just says monster problems. You know, as we've been talking here, you can see the 10-year as well as the 30-year is accelerating on the way up once again. If we take a look at the TLT, you'll see the TLT all-time highs. But my take, this is going to be crazy, man. My take's we're going to negative rates, and man, I wish I could figure this out. Like, what does that mean? You know, but you can see if we go take a look at this 10-year, there's no reason. It's the way that we're barreling into the lows, folks. That's what's going on here. You know, we're at 1.51 this morning. Right now, you're 1.55. You know, when I was talking about first at 1.7, we were up here at 2, and then it was like the way that we came down from the 2 to 1.8. It was like, okay, no, 1.3 is going to get hit, and guess what? Last 2 weeks, you get these monster moves, man. I mean, it's just these are not small moves. This is like forceful movement, and we're already at the top. We're already into the bar. But the bar that we're talking about is the July bar of 2016. The top of that was a yield of 1.62. The bottom is 1.31. We're at 1.55. Now, that wouldn't be, I wouldn't be saying if it's going to break it if we had the aspect of it was a small bar. This bar is a monster, folks, okay? This is just a non-stop deal. We've come down, so check this out. We've come down, oh, excuse me, folks. We've come down 0.5%. 0.5% this month. And it's only August 15th. And you're talking about 0.5% off 2%. So what is that, 25%, right? 25% move? That's unheard of in the bond market. Well, it's not unheard of because we just did it. And you know, bonds have been volatile for a long period of time. We're not in the bond market of like the 1990s. It's going to blow it away. Stay right there, folks. Come right back. Phone number is 877-927-6648. Dow Industrials up 31, Nasdaq's up 4, S&P's up 8. Come right back.
I'm certain you are or strive to be one of the best at everything you do in life. It's the most common trait that we tigers and tigresses share. If you're looking to become the best of the best when it comes to managing your money, let me teach you to do what most wealth managers tell you can't be done, which is how to time the markets. I'm Steve Rhodes, author of Mastering Probability, and for the last 12 months, Timer Digest has been tracking my newsletter signals, which have earned me the ranking as their #1 market timer in the nation for the S&P 500 for the last 12, 6, and 3 months. Timer Digest also ranks me as the #1 market timer for gold as well. The fact is, markets can be timed, and I'll teach you the exact set of tools that I use that has transformed me into one of the best at what I do. Sign up for Mastering Probability today by clicking on the newsletter tab on the homepage of TFNN.com and get immediate access to workshops where I take you step by step how to use an extraordinary set of tools as well as provide great market calls too. Sign up today.
It's amazing to think that Tom O'Brien started his weekly gold report 17 years ago with the first issue published April 7th, 2002, when gold was trading at under $300 per ounce. Gold peaked at more than $1,900 in 2011, and after spending many years consolidating at lower prices, gold may be poised for its next big run. Tom O'Brien publishes his weekly gold report every Monday morning for subscribers, consisting of coverage of the XAU, HUI, GDX, the dollar, bonds, South African Rand, as well as 25 different mining equities with specific buy-sell recommendations. As of April 1st of this year, the gold report currently has 8 active positions with an average unrealized profit of almost 8% for each open trade. New subscribers get a 30-day money-back guarantee, so you have nothing to risk. For all the details and to start your gold report subscription today, visit the front page of TFNN.com. Don't let gold's next big run pass you by. Sign up today. Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Welcome back, folks. And this is a great question by one of the Tigers in the Den. And what it was, folks, is that if rates go negative, what will happen to insurance companies? So check this out. What I did is I brought up this is Peng In, and this is the largest insurance company in Japan. So Japan would be where we absolutely want to basically do some work, because they've been in the negative rates for years. Like, I can get the number, but it's over 10 for sure. And that being said, guess what? You bring this chart up, and this is an equity that's almost at all-time highs. You know, so I'm not quite sure how they do it, but that's something that we will get our head wrapped around, because the bottom line is that you know, in general, yeah, in insurance companies, the bottom line, they have to make a certain amount, and you know, in life insurance they're at what, 572 billion, property 231, banking 210. You know, but somehow they're making money, and they are definitely printing money. When you go from 2015 to 2019, you're going from $2.98, and now they're banging out $7.54. So there's no doubt that there's ways that negative rates, you know, basically people still can make money. Now, one of the danger in negative rates is that you're doing basically rollovers. You know, you're selling one currency, you move into another, you're selling one. Strip of interest-bearing short-term and you're going long-term with it. What ends up happening that, and this is where blow-ups do take place, folks, is that when you're not balanced, that is when you can lose a fortune. And those trades are telling you just about, those are not balanced trades. Those are, you're just hoping that it doesn't implode like intraday sometime. Stay right there, folks. We got TD Ameritrade coming up next. I'm our man, Mr. Basil Chapman, Steve Rhodes, Dave White. Be back this afternoon. Have a great one, folks. Have a safe one.